Hello and welcome. In this tutorial, I'll walk you through one simple trading strategy that every trader should know. This strategy is effective and easy to apply. I'll be using the Deriv platform. You can access it through the link in the description below. This is Volatility 10 Index, but this strategy can be applied to different markets. You'll need 3 indicators, but keep in mind that I'm not using them to generate any signals. I had already illustrated how to use the indicators in my previous videos. The moving average and the simple moving average will help in identifying the dominant trend on the one-day chart, while the stochastic oscillator helps identifying overbought and oversold conditions across different time frames. The moving average appears as a red line. The Bollinger Bands display as 3 white lines, but I'm more interested in the middle white line, which is the simple moving average, and the stochastic oscillator appears at the bottom of the chart. Once you've added the indicators, the first step is always to identify the dominant trend on the one-day chart. I had already illustrated how to check for the dominant trend in a previous video that I'll link at the end of this video. After identifying the dominant trend, wait for a candlestick breakout in the direction of the dominant trend. Some breakout candlesticks are strong and close without a wick, while others have a wick, indicating there was a pullback. I'll show examples of breakout candlesticks in line with the dominant trend. For this illustration, I'll use this bearish dominant trend on the one-day chart. Since we've already identified the dominant trend, I'll remove the Bollinger Bands to make this illustration clearer. This bearish breakout candlestick closed without a wick, while this other bearish breakout candlestick closed with a wick. The strategy is to enter a trade immediately after a breakout in line with the dominant trend and close the trade when a retracement begins. For example, during this bearish dominant trend, we see a breakout candlestick with a wick. In this case, I entered after the breakout at this level. I'll use a horizontal line to show the breakout point. And closed when a retracement started. To confirm retracements, I used top-down analysis. The 8-hour and the 4-hour charts were not oversold at the time of this breakout, but reached oversold levels later. However, the 2-hour and the 1-hour charts were oversold at the time of the breakout. This doji on the 1-hour chart was an indication of the start of a retracement, and that's where I closed the trade. We can see the retracement lasted for several hours. As I mentioned in a previous video, when an overbought or oversold condition prolongs, it extends to the next larger time frame. Here, the oversold condition on the 1-hour chart prolonged and extended to the oversold condition of the 2-hour chart. Therefore, in this case, I used these two charts to check for candlestick signals to confirm the start and end of this retracement. I had illustrated this in a previous video, how to check for candlesticks that indicate the start and end of a retracement, and had also illustrated 2 types of retracements in trading. I'll link these 2 videos at the end of this video. In this example, the retracement caused the breakout candlestick to close with a wick. On the other hand, this other breakout candlestick closed without a wick, meaning there was no retracement on that day, but a retracement occurred the next day. That's why the next day's candlestick was bullish. Then the bearish dominant trend continued. A wick indicates that prices reached a certain point, then there was a pullback as the candlestick closed. When larger time frames are retracing, the retracement may last several hours, a day or longer. That's why I prefer closing the trade when a larger time frame starts retracing. You can also trade the retracements, but trading the dominant trend is more predictable. This is the 1-hour chart on the day of the breakout, and you can see that the breakout movement continued for several hours. The main reason why I prefer placing a trade after the breakout is because of false breakouts. For example, this bearish pin bar was a false breakout. If someone placed a trade before the breakout, thinking that this would be a breakout candlestick, then they would have lost the trade. It's also important to know the safest trade type to choose. On the right sidebar, you'll find several trade types. Multipliers is best for beginners. Lower multipliers are slow in adding up profits and slow in deducting losses, while larger multipliers are quick in adding up profits and also quick in deducting losses. Since the trade from the breakout point to the retracement takes a few hours, lower time frames like the 10-minute chart and others will retrace multiple times, then continue the trend. To avoid unnecessary losses during short-term retracements, using a lower multiplier instead of a higher multiplier is advisable. Other trade types have time limits, like the higher-lower or rise-fall. When using these, keep in mind the retracements in the different time frames. Therefore, practice the different trade types on a demo account to see which works best for you. It's also important to know how much to stake per trade. Stake is the amount of money placed on each trade, and this depends on your account balance. It's advisable to risk only 1% to 3% of your account per trade. This protects your account and allows multiple trades. I'll show an example of a risk management plan. Let's say you have a trading account of $500. If you choose a stake of 1%, this will be equal to $5. It's important to note that higher risk equal to higher potential reward or loss, while lower risk equal to smaller but more consistent gains. You can use a risk-reward ratio of 1 to 2, meaning that your take profit will be twice your stake. In this case, if your stake was $5, then the take profit will be $10. The stop loss should be 50% of your stake. In this case, if the stake was $5, then the stop loss will be $2.5. Most of the time when your stop loss is reached, it indicates that the market moved against your trade. Therefore, you should always do proper analysis before placing a trade. You don't need to trade every day. Avoid unnecessary losses by waiting for clear setups. Always practice on a demo account before trading with real money. If you found this tutorial helpful, don't forget to like and subscribe. Thank you.